Have you noticed that some of your worst trades happen right after you finally feel confident enough to enter? Price breaks out, momentum looks strong, and the move seems obvious. You click buy expecting continuation. Then the market pulls back, shakes you out, and only afterward moves exactly where you thought it would. The painful part isn't the loss. It's realizing your direction was right, but your timing was wrong. And that's where the pullback entry secret begins. The market rarely rewards impatience. Strong trends attract attention, and attention attracts late buyers and sellers. When everyone rushes toward the same obvious move, price often needs to retrace before it can continue. Why? Because markets move through imbalance and correction. An aggressive move creates distance from value. A pullback is often the market's way of testing whether that move was genuine or simply emotional enthusiasm. Have you ever wondered why the cleanest trends seem to pause right when traders become convinced they'll never stop? That pause is information. A pullback is not automatically weakness. In many cases, it's evidence of strength. Strong hands are rarely interested in chasing price. They prefer opportunities where risk is smaller and uncertainty has already been reduced. The beginner sees a pullback and fears the trend is ending. The experienced trader asks a different question. Who is actually selling here? That distinction changes everything. When a trend is healthy, pullbacks often show declining momentum. The correction becomes smaller than the impulse that came before it. Volume may decrease. Volatility may contract. Price pulls back, but conviction does not. That tells you something important. If sellers cannot create meaningful damage after a strong advance, control likely remains with buyers. The same principle works in reverse during downtrends. Now think about the practical advantage. Would you rather enter after an emotional expansion, where your stop must be wide and your risk is large? Or would you rather wait for price to return toward an area where the market has already shown interest? Patience changes the mathematics of trading. A good pullback entry allows you to define risk clearly. It creates a logical location for a stop. It improves the reward to risk relationship without requiring you to predict anything extraordinary. But there is a trap hidden inside this idea. Not every pullback deserves your attention. A pullback that breaks market structure is different from a pullback that merely tests it. A retracement that accelerates with aggressive volume tells a different story than one that drifts lower with hesitation. Can you see why so many traders struggle here? They learn to buy pullbacks, but they never learn to read the quality of the pullback itself. The secret is not entering because price retraced. The secret is understanding what the retracement reveals about the balance of power. Watch how price behaves when it reaches a prior support zone. Observe whether momentum fades into the correction. Notice whether buyers begin responding before price reaches obvious levels. These details often matter more than the pullback itself, because the best entries are rarely hidden in the breakout. They're hidden in the reaction that follows it. A pullback is not a setup. That is the first distinction worth understanding. Price can move lower after an advance. It can retrace 50% of a move. It can touch support, reach a moving average, or return to a previous breakout level. None of those things, by themselves, create an opportunity. Yet traders often treat the pullback itself as the signal. The market doesn't reward labels. It rewards conditions. So before a pullback becomes tradable, 3 conditions must exist. Remove any one of them, and what looks like an opportunity can quickly become a trap. The first condition is a proven move before the pullback begins. A retracement only has meaning when there is something to retrace. Think about it. If price has been drifting sideways for days, what exactly is the pullback correcting? Nothing. There is no demonstrated imbalance. No evidence that one side has gained control. A quality pullback starts with a decisive move. Buyers or sellers must first show their hand. The market must reveal a direction before it offers a pause. Without that initial display of strength, the pullback becomes little more than random movement. The second condition is controlled retracement. This is where many traders become confused. They see price moving against the previous trend and assume every decline is simply a temporary pause. But the manner of the retracement matters as much as the retracement itself. Ask yourself a simple question. Is the market correcting, or is it attacking the prior move? There is a difference. A controlled pullback tends to move with less urgency than the impulse that preceded it. The market gives ground, but it does not surrender it aggressively. The correction feels measured rather than forceful. Why is that important? Because behavior reveals intent. When a strong move encounters only moderate opposition, it suggests that the dominant side remains largely in control. The pullback exists, but conviction behind it appears limited. The market is not just moving, it is communicating. The third condition is evidence that the pullback is losing momentum. This is the point many traders skip. They identify the trend, they identify the retracement, then they enter simply because price has reached an area they consider important. But location alone is not enough. A pullback becomes tradable when signs emerge that the correction is running out of energy. Think about the logic behind it. If the retracement is still strong, entering means stepping directly into active pressure. If the retracement is weakening, the balance of power may be shifting back toward the original move. The difference seems small on a chart. In practice, it changes everything. You are no longer buying because price has fallen. You are buying because the decline appears to be exhausting itself. You are no longer selling because price has risen. You are selling because the rally against the trend appears to be losing strength. Can you see how these three conditions work together? The first condition establishes that there was genuine strength. The second condition shows that the correction remains controlled. The third condition suggests that the correction may be nearing its end. Remove the first condition, and there is no meaningful trend to participate in. Remove the second, and the retracement may be signaling a deeper change. Remove the third, and you may simply be entering too early. The market rarely announces its intentions with certainty. What it does provide are clues. These three conditions help organize those clues into something useful. A surprising truth about pullback entries is that they do not necessarily make you more accurate. The market does not suddenly become easier to predict because you waited for a retracement. Price can still reverse. The trend can still fail. Your analysis can still be wrong. Yet experienced traders continue to favor pullback entries. Why? Because accuracy is only one part of the equation. The size of the risk compared to the size of the opportunity matters just as much. This is where many traders spend years looking in the wrong direction. They become obsessed with finding a method that wins more often. They search for confirmation indicators and filters that might increase their hit rate by a few percentage points. Meanwhile, they ignore something far more influential: the relationship between what they are risking and what they stand to gain. Imagine two traders who identify the same market move. The first enters after a strong expansion. Price has already traveled a significant distance. The trade may still work, but the entry is now far from the area that would prove the idea wrong. As a result, risk expands. The second trader waits for a pullback and enters closer to the area where the original move began to show strength. Notice what changed. Not the direction, not the prediction, not the probability, only the price of admission. That distinction is easy to overlook because charts naturally draw attention toward outcomes. We focus on whether the trade won or lost. The market, however, pays according to arithmetic. A trader who risks 10 units to make 10 units needs a very different success rate than a trader who risks 3 units to make 10. The destination may be identical, but the economics are completely different. This is why pullback entries can improve a trading approach without improving forecasting ability. They often reduce the distance between entry and invalidation. When that distance shrinks, risk shrinks with it. And when risk shrinks while opportunity remains relatively unchanged, the reward to risk relationship improves. That improvement creates consequences that compound over time. Consider what happens when a trade fails. A trader who entered after a large extension often absorbs a larger loss because the market had already traveled far before the position was opened. A trader who entered on a pullback may discover the idea was wrong as well, but the cost of being wrong is frequently smaller. The market charges tuition for mistakes. Pullback entries often reduce the tuition. Do you see the subtle shift taking place? The goal is no longer to avoid losses entirely. The goal is to structure losses so they require less recovery. Because every loss creates a mathematical obligation. Lose 10%, and you need more than 10% to recover. Increase the size of losses repeatedly, and the recovery burden grows. Smaller risk changes that equation. This is why professional speculation has always been closely connected to entry efficiency. A trader cannot control what the market will do next, but the trader can influence the terms under which risk is accepted. That is one of the few variables fully under personal control. A pullback entry is essentially a negotiation. You are attempting to participate in a potential move while demanding a better price for the risk being assumed. Sometimes the market grants that opportunity. Sometimes it does not. But when it does, something important happens. The potential reward remains tied to the larger move ahead, while the amount placed at risk is often tied to a smaller area nearby. That imbalance is where the real value emerges. Not because the market becomes more predictable, not because winning suddenly becomes easier, but because the numbers begin working differently. A pullback is often treated as a price event. In reality, it is an information event. The average trader sees a market move higher, then pull back, and immediately focuses on where price is going next. But a more useful question is different. What does this pullback reveal about the struggle between buyers and sellers? Because every retracement tells a story, not through opinions, forecasts, or indicators, but through behavior. A market can only move lower during a pullback if sellers are willing to sell and buyers are willing to step aside. The interesting part is not that price retraces. The interesting part is how much influence sellers actually possess once the retracement begins. That influence leaves clues. Imagine a strong advance. Buyers push price upward with conviction. Then the pullback starts. At that moment, sellers have an opportunity. They have a chance to prove that the previous advance was vulnerable. They have a chance to seize control and reverse the move. The pullback becomes a test, not of the trend itself, but of the opposing side's ability to challenge it. And every test produces a result. Sometimes sellers push aggressively and price quickly gives back a large portion of the prior move. That behavior reveals something important. Resistance against the trend is stronger than it first appeared. Other times, sellers participate, but their impact remains limited. Price retraces only modestly before demand begins appearing again. The difference is not subtle. One outcome suggests growing opposition. The other suggests that opposition exists but lacks authority. Can you see why the pullback matters? The retracement exposes information that was invisible during the initial move. When price is rising rapidly, it is difficult to measure the strength of sellers because they are largely absent from the auction. The pullback forces them into view. Now their influence can be observed. Now their effectiveness can be judged. This is why experienced traders pay attention to the character of a pullback rather than its mere existence. A retracement is not simply movement against the trend. It is evidence about the balance of power. If sellers require substantial effort to produce only limited downside progress, that reveals one condition. If they produce significant downside progress with ease, that reveals another. The same logic applies in reverse during declining markets. What matters is not who participates. What matters is what their participation accomplishes. Markets constantly measure effort against result. This relationship appears repeatedly across all time frames. A side can become very active and still fail to achieve meaningful progress. When that happens, valuable information enters the market, because effort without result often reveals underlying weakness. Conversely, when a side achieves large progress with relatively little resistance, underlying strength becomes visible. The pullback acts as a window into this process. It allows you to observe whether the opposing side is merely present or genuinely effective. Those are not the same thing. A market can attract sellers without becoming bearish. A market can attract buyers without becoming bullish. The critical question is always whether their actions are producing lasting control over price. Once you begin viewing pullbacks this way, charts start to look different. The retracement stops being a temporary interruption in the trend. Instead, it becomes a diagnostic tool. a method of examining the health of the move that came before it. You are no longer asking, how far has price pulled back? You are asking, what has the opposing side been able to accomplish since this correction began? That shift changes what you pay attention to, because the market rarely reveals strength through aggressive movement alone. Often, true strength becomes visible through resilience. It appears when pressure arrives and fails to create the damage that logic suggests it should. One of the most expensive habits in trading is acting when no action is required. The market presents a pullback, and suddenly the trader feels pressure to make a decision. Price is moving. An opportunity appears to be forming. The fear of missing the next move begins to grow, but a pullback does not automatically create an obligation. Sometimes the highest quality decision is not participation. It is observation. That idea sounds simple until money becomes involved. When traders study charts after the fact, patience looks obvious. During a live market, patience feels costly. Every candle creates the illusion that a decision must be made immediately. Yet the market operates differently. A pullback is not valuable because it offers a chance to enter. A pullback is valuable because it creates a chance to evaluate. There is a difference. The purpose of waiting is not inactivity. The purpose of waiting is information gathering. Every moment that passes during a pullback reveals something new about the market. The correction may remain orderly. It may become increasingly aggressive. It may stabilize. It may deteriorate. None of those outcomes are visible at the beginning. They become visible only through time. Have you ever noticed how many poor decisions are made in the earliest stages of a pullback? The reason is straightforward. At that stage, uncertainty is highest and information is lowest. The trader is attempting to answer a question before the market has finished presenting the evidence, because markets unfold in sequence. First comes movement, then comes reaction, then comes information. Trying to force a decision before the information emerges often creates unnecessary risk. The desire to act arrives before the evidence required to justify the action. This creates an important distinction. There are moments when a pullback presents an opportunity. There are also moments when a pullback presents a question. Confusing the two can be costly. A question requires observation. An opportunity requires commitment. The market does not always offer both at the same time. Consider what happens when a trader enters simply because price has reached an anticipated area. The decision is based largely on expectation. The trader assumes the market will behave a certain way, but assumptions are not evidence. Evidence emerges through actual behavior. How does price respond? How does the correction develop? Does the market behave consistently with the original premise? These answers become available only after patience has done its work. Waiting is often misunderstood because it produces no immediate reward. Buying creates activity. Selling creates activity. Waiting creates nothing visible. Yet some of the most valuable information in speculation appears during periods when no position exists. This is where decision-making becomes less about prediction and more about selection. You are not attempting to force a trade from every pullback. You are deciding whether the developing information justifies involvement. That shift matters, because every trade begins as an idea, but not every idea deserves capital. The market generates possibilities continuously. The trader's responsibility is not to participate in all of them. The responsibility is to distinguish between possibilities that are still forming and possibilities that have revealed enough evidence to warrant action. This requires a willingness to remain undecided. A quality decision is not always immediate. Sometimes the market must continue revealing itself before a decision becomes clear. The difference between an occasional pullback trader and a consistently prepared one is often not knowledge. It is routine. Most traders know what a pullback looks like. They can identify one after it appears. They can point to examples on historical charts and explain why the setup worked. Yet when the market is live, the same traders struggle to find quality opportunities consistently. Why? Because recognition and preparation are not the same thing. A routine exists to solve that problem. The market generates thousands of movements every week. Some are meaningful. Most are not. Without a structured process, every chart demands a fresh decision. and every decision consumes attention. Over time, this creates inconsistency. One day the trader notices an opportunity. The next day the same opportunity is overlooked. The market has not changed. The process has. This is why professionals rely on routines. A routine reduces dependence on memory, mood, and chance observation. Instead of asking, "What should I do today?" the trader begins with a predefined sequence of observations. The market is examined in the same manner each day. The same questions are asked. The same conditions are reviewed. The same criteria are applied. This may sound repetitive. That is precisely the point. Consistency in observation creates consistency in detection. When a routine is absent, attention tends to follow excitement. The trader spends time chasing movement that is already obvious because obvious movement attracts attention naturally. Meanwhile, quieter opportunities often go unnoticed. A routine corrects this imbalance. It directs attention before emotion has a chance to redirect it. Think about how a skilled craftsman approaches work. The quality of the result often depends on preparation completed before the work begins. Tools are organized. Materials are inspected. Conditions are evaluated. The preparation creates efficiency later. Trading is no different. A routine creates readiness before the opportunity appears. This readiness matters because pullbacks are temporary. The market does not pause while the trader decides what to examine. If the process of identification begins only after the pullback has already developed, valuable information may already be gone. Preparation allows the trader to arrive early rather than react late. Can you see the advantage? The goal is not to predict where pullbacks will appear. The goal is to maintain awareness of markets where pullbacks would matter if they occurred. That distinction changes the nature of the work. Instead of hunting randomly, the trader monitors deliberately. Instead of searching for opportunities everywhere, attention is directed toward places where opportunities are more likely to emerge. Over time, this produces another benefit. Patterns become familiar. Markets that are reviewed regularly begin to reveal their tendencies more clearly. Small changes become easier to recognize because there is an established frame of reference. What seemed invisible before becomes noticeable through repeated observation. This is one reason experienced traders often appear intuitive. Their decisions are not necessarily based on instinct. They are based on familiarity created through disciplined repetition. The routine builds the familiarity. The familiarity improves recognition. The improved recognition increases the likelihood that important developments are noticed while they are still developing. And eventually the trader stops relying on isolated moments of focus. The process itself begins carrying part of the workload. Each day follows a sequence. Each review serves a purpose. Each observation contributes to a larger picture. The moment a pullback entry is filled, a subtle shift takes place. Before the entry, the primary task is evaluation. After the entry, the primary task becomes management. Many traders fail to recognize this transition. They spend considerable effort searching for an opportunity, then give surprisingly little attention to what happens once they are actually involved. Yet the market does not pay for good entries alone. It pays according to how positions are handled after the entry is made. A pullback entry creates a unique situation. The trade begins from a position of relative efficiency. Price is already retraced. The entry is closer to the area that justified participation. The position often starts with less distance between entry and invalidation than an extended entry would require. That advantage should not be ignored once the trade begins. In fact, it should influence every decision that follows. Why? Because the purpose of securing an efficient entry is not simply to enter. The purpose is to improve the quality of the position itself. A trader who gains that advantage and then manages the position carelessly has effectively wasted part of what the entry provided. This is where observation becomes important. The market continues communicating after the trade is opened. Many traders behave as though all relevant information existed before the entry. In reality, new information is constantly emerging. How does price behave after participation begins? Does it respond in a manner consistent with the original expectation? Does it begin moving away from the pullback area with conviction? Or does it linger, hesitate, and struggle? These questions matter because a position is not a static prediction. It is an ongoing interaction with a changing market. The initial entry provides a hypothesis. Subsequent price behavior provides feedback. The quality of trade management often depends on how effectively that feedback is interpreted. Consider the logic behind a pullback entry. The trade is typically based on the expectation that the correction has completed and that the prior directional move may continue. If that expectation is valid, some evidence of continuation should eventually appear. The market does not need to move immediately. But over time, behavior should begin aligning with the premise behind the position. When that alignment develops, confidence in the original idea tends to strengthen. When alignment fails to develop, the position deserves renewed scrutiny. This creates an important principle. Management is not about forcing the market to justify the trade. Management is about observing whether the market is actually doing so. There is a meaningful difference. One approach attempts to defend a decision. The other attempts to evaluate a decision. The market rewards the second approach far more often. Have you ever noticed how some positions feel increasingly healthy as time passes, while others seem to require constant explanation? That difference is rarely accidental. Price behavior after entry often reveals whether the original premise is gaining support or losing credibility. The trader's responsibility is to observe that process honestly, not emotionally, not defensively, objectively. A pullback entry provides a specific starting point from which the market's response can be measured. The trade begins in a location where important information is concentrated. Because of that, what happens next carries significance. Each movement away from the entry contributes evidence. Each failure to progress contributes evidence as well. Management becomes the process of interpreting those developments rather than simply holding a position and hoping for a favorable outcome. Over time, experienced traders learn that the entry itself is only the beginning of the conversation. The market continues speaking after capital is committed. The market does not punish traders because pullbacks are difficult to find. It punishes them because pullbacks are easy to misunderstand. That distinction matters. Most mistakes surrounding pullback entries are not the result of ignorance. They come from misinterpretation. Traders see a familiar shape on a chart and assume they understand what it means. But the appearance of a pullback and the reality of a pullback are not always the same thing. One of the most common errors is treating every retracement as an opportunity. A market moves in one direction, pauses, and immediately traders begin preparing for continuation. The assumption seems reasonable because pullbacks often precede further movement. The problem is that they do not always do so. A retracement is a description of behavior, not a guarantee of outcome. When traders forget this, they stop analyzing and start assuming. The chart begins telling them what they want to hear rather than what it is actually communicating. Another mistake emerges from oversimplification. A trader learns that successful trends often pull back before continuing. That observation is true. But then the observation becomes a rule. Every pullback becomes something to buy or sell. The market, however, rarely rewards rigid interpretation. Conditions change. Context changes. The meaning of a retracement changes. What worked in one situation may communicate something entirely different in another. The mistake is not the observation itself. The mistake is treating a tendency as a certainty. Have you ever noticed how traders often become attached to the first explanation that comes to mind? Price begins retracing, and a conclusion forms immediately. This is just a pullback. The danger lies in the word, just. That single word can eliminate curiosity. Once the trader believes the answer is already known, observation slows down. Evidence that contradicts the assumption receives less attention. Alternative interpretations disappear. The market becomes filtered through expectation rather than examined objectively. There is another subtle error that appears frequently. Traders focus on the existence of the pullback while ignoring its development. The setup is identified too early. The label is applied before enough information has emerged. As a result, the trader reacts to an unfinished process. This is similar to judging a story after reading only a few pages. The ending remains unknown, yet a conclusion has already been reached. Markets reveal themselves over time, Pullbacks are no exception. The quality of interpretation depends heavily on allowing the market to complete enough of the process to reveal meaningful information. A different mistake occurs when traders become excessively focused on precision. They search for the perfect pullback, the exact level, the exact candle.